Welcome back to this Money Control live stream. You're watching Closing Bell with me, Nandita Khemka, and my colleague.
Hello there, I'm Yatin Mota.
Well, Yatin, we've started the week on a solid note, given the fact that 25,100 is back on the charts, a triple-digit up move coming in, over 160-point gain on the index. Mind you, last week we were trying to, end above the 25,000 mark almost all of last week, but, we didn't really succeed there. But today, of course, earnings-heavy week, and we've started it with a bang. 25,100 back on the charts, and it's the benchmarks that were outperforming the broader end of the markets. It was the reverse last week, but relative underperformance coming in from mid caps and small caps. But of course, advanced decline ratio also even Stevens 1:1, but slightly tilted in favor of gainers. Sectorally, what did well was IT, led from the front. So did banks and even the realty pack. All three indices gained in excess of 1%. What didn't do well was the metal pack. Of course, it's a China stimulus that underwhelmed once again. No size of the stimulus, even though they've said that they will do much more to boost the property market. They will, provide subsidies to low income group. They will do more in terms of debt issuance as well. But no size has been, outlined for this fiscal stimulus, and that came as a disappointment for the metals pack.
In fact, Nandita, the Chinese official press conference did not, give the details, indications, the size.
Yeah.
I think if you look at the Western media, the coverage was saying that the Chinese press conference was quite opaque. So there was no clarity, as you were mentioning, with regards to the stimulus. And, there was a lot of build-up and the hope last week that once details of the stimulus come out, probably the metal stocks will fire up. Nothing of that sort happened.
Yeah, and of course, there's a deflationary scenario also playing out in China. So all this weighed in on metals. That was the sole sectoral laggard. After media, I think media as a pack also didn't do all that well. But in terms of individual movers, Wipro, leading from the front today on the index, 4% up move. It will consider bonus issue when it reports numbers on the 17th. On the back of that, that stock was doing well. Tech Mahindra also among top nifty gainers. HCL Tech, which reports numbers after market hours, it saw a sudden spurt right before close. So it has ended high by about 1.5% or thereabouts. We'll talk about expectations in just a bit. HDFC Life reports numbers later this week. That stock was doing well. HDFC Bank was doing well, given the fact that private banking names were doing well today. L&T on the back of an initiation by a brokerage, that stock was among gainers, and even ITC was among the gainers. What didn't do well? The likes of ONGC, Maruti, even metal names like Tata Steel, Bajaj Finance, Adani Enterprise. These are some of the other laggards on the index. But Yatin, DMart, biggest fall on the stock, single day fall for the stock since 2019 on the back of poor numbers.
Absolutely, and if you look at the mid cap end of the market, stocks like BSE, CDSL, Finolex Pipes, Raymonds did well, but as you're mentioning, DMart slow growth clearly impacting the numbers, and stock down 9%. We'll talk about that stock in detail. Tata Chemicals, the stock is down 6.5% today. There were hopes that the Tata Sons IPO will come out, or some kind of speculation there. But last week the long build-up turned into selling in the week today. When it comes to Bandhan Bank, after a 10% stellar move on Friday, stock fell 4%. Colgate also declining in trade. I think the overall sales trend for FMCG companies and retail companies are not that great. Probably private labels are taking over, and quick commerce is something that is to be watched out for. But Nandita, a mixed trading session for the mid caps, and if you look at the advanced decline ratio also, Friday also around 1:1, and today also nearing 1:1.
Right, that was the texture of the market, both when it comes to frontline indices as well as the mid cap end of the markets. But of course, earnings in full swing. And big boy Reliance Industries will be reporting numbers today. Mixed set of numbers. That's what analysts are expecting. Steady telecom and retail growth may cushion some bit of weakness in the oil to chemicals business, Yatin. But investors will focus on Jio's ARPU growth. Of course, we saw a tariff hike coming in last quarter. So Jio, those numbers will be crucial to watch out for. Growth in retail segment is another thing that the street will be keenly watching out for. There could be some bit of weakness on earnings, of course, on the back of weaker oil to chemicals margins. But as I mentioned, revenue, of course, is expected to fall marginally to somewhere around 2.3 lakhs on a quarter-on-quarter basis. Net profit is also expected to fall somewhere around 12% to 15,300 crore rupees or thereabouts. But as I mentioned, it's the retail and telecom arm. All eyes will be on these two segments on the back of the tariff hike announced, and even resilient demand, when it comes to the retail end of the business. So these are some of the factors. But of course, if you look at brokerage expectations, I just want to highlight that Elara Capital has said that GRMs, gross refining margins, could come in at 9 barrels vis-a-vis 19 barrels on a YOY basis. And MK, on the other hand, is expecting O2C EBITDA to fall by 3% on a sequential basis. Now, brokerages are saying that the lower GRMs and weaker refining spreads are the key reasons for this decline. But if you look at Prabhudas Leeladhar, it sees a 6% growth, QOQ growth, a sequential growth in Jio's ARPU to 194 rupees. Prabhudas Leeladhar also sees a 0.6% sequential increase in the subscriber growth. Of course, Reliance Jio has been steadily gaining subscriber and expanding its subscriber base, and that will be reflecting in the numbers as well. JM Financial, meanwhile, expects retail EBITDA to also increase by 0.6% on a quarter-on-quarter basis. This despite challenges such as store rationalization as well as heavy monsoon season. MK, on the other hand, is projecting retail EBITDA to rise by 1% on a quarter-on-quarter basis, which of course will be driven by resilient consumer demand. And upstream segment could also see some bit of a slight dip in performance in the quarter gone by. So overall, a mixed quarter expected, but any weakness that will be seen in the oil to chemicals business will be offset by strength in retail as well as telecom.
Absolutely, and I think Nandita, the oil and gas business or the petchem business continues to be volatile. I think the volatility in crude prices, the geopolitical conditions have clearly. When it comes to telecom and retail, the base effect also plays a role. So the absolute growth numbers might not be that big as it used to be in the earlier quarters. But yes, the ARPU for Jio business, the like-to-like growth for retail, and the GRMs is something we'll be watching out for. These are the three big numbers usually which set the tone of the share price in the day post the results. And talking about Reliance, the shares have corrected from 3,200 odd on the AGM day to almost 2,600, 2,700 levels. Recent highs, whether or not there could be some further pressure on the stock price because of results or a substantial upside, that is something we'll watch out for. But yes, any value unlocking, any announcement on IPOs is something that the market will be watching out for keenly.
That's true, Yatin. Your stock, let's come to that. DMart, it saw its biggest single day fall since January 2019, and of course it has also faced a slew of downgrades.
Absolutely, and 9% down on the share price of Avenue Supermarts, which is DMart. Now, if you look at the stock today, clearly under pressure post the Q2 updates. Most importantly, JP Morgan has downgraded the stock of DMart to neutral. The target has been cut by nearly 700 rupees. So, big target price cut, and the new target for DMart now stands at 4,700. Obviously, the Q2 details are below expectations. Revenue growth moderate under the back of slower like-for-like growth. Yes, the company has admitted that the quick commerce companies are, giving stiff competition, be it Blinkit or be it Swiggy Instamart or be it Zepto. All of these companies are clearly impacting, the growth for brick and mortar stores. The press release this time noted clear impact of online grocery formats. The moderation of growth clearly surprised most of the analyst community, and JP Morgan has lowered the revenue forecast by nearly 4 to 6% in the next 2 financial years. Clearly, not only downgrades but target cuts as well as EPS cuts is something which has impacted the sentiment, the stock price today.
That's true. An interesting fact, the Tata Group owned Trent has overtaken DMart in market cap as well. And if you look at the stock performance of DMart, I think in the last 1 month it has shaved off almost or over 20% or thereabouts. So clearly under pressure, and how the competition really commerce business is something that will decide the future. But of course, JP Morgan has also pointed out that they are really surprised by the kind of dip or fall they have seen in the same store sales growth. That's one factor that has also led to the downgrade. But the other big number to watch out for today will be HCL Tech. Remember, TCS has set a pretty subdued tone for IT earnings at least this quarter, but that's a more of a company-specific issue. Because of the higher third-party expenses, margins saw some bit of a hit, and it was a big miss on the margin front. But speaking about HCL Tech in particular, here as well, no fireworks expected, so to say, but revenues will see a sequential rise of somewhere around 1.6% or thereabouts, but net profit could face some bit of pressure. And there would be weakness in software as well as products businesses, and these are some of the factors that would impact profitability. But also the absence of revenue from the divested State Street BPO is something that could weigh in on numbers, because the State Street BPO stake sale that happened earlier this year may result in some bit of a loss on revenues to the tune of 80 basis points, as was being outlined by Nomura. So that's something that could make the earnings a little soft. Looking at, I think it was 80 basis points or $97 million of revenue.
Yeah.
That is the kind of impact that was being expected due to the divestiture of the State Street BPO. But aside of that, margins are expected to expand around 70 basis points on a sequential basis. There's been absence of visa costs, improved business mix. These are some of the factors that could aid margins, even though products and software business will see some bit of weakness. Guidance, that's one thing that the street really watches out for. For CC revenue, constant currency revenue, the company is expected to maintain its revenue guidance at 3 to 5%. But for margins as well, 18 to 19%, this guidance is expected to be maintained. Key to watch out for will be deal pipeline, how deal environment is shaping up. Hiring plans, because the company had seen a net headcount fall by 8,000 or so last quarter, and it has earlier said that it plans to hire 10,000 freshers this year. But TCS, mind you, saw a second straight quarter of headcount addition. But Infosys, HCL Tech, all the other IT companies have not seen that yet.
Yeah.
So if that happens, that could be one factor to watch out for. Aside of that, outlook on services, software segments. Also the fact that, since now Fed has rolled out a jumbo 50 basis point rate cut, and there are expectations of more rate cuts to come as we go ahead this year, how the discretionary demand environment is shaping up is also something that the street will be watching out for. So overall, no fireworks expected, but margins are expected to expand by 70 basis points for HCL Tech.
Absolutely, and IT, the trade is quite tricky because for the last 2-3 quarters, Nazira, TCS has given different results. Infosys has, gone on different trajectory. One quarter Infosys cuts guidance, the other quarter it raises guidance. I think a lot of confusion, and till the time we don't have a clear picture on the US economy, the US elections, I think that discretionary spend bit is something which is a tricky thing for investors, and hence the volatility in the IT earnings as well as the IT outlook. But yes, we'll watch out for HCL Tech's and Reliance Industries earnings. You have to stay tuned to Money Control, because Nandita will get you all the analysis today and early morning tomorrow.
Yeah, we will be discussing HCL Tech and all the other earnings as well. Of course, we have Infosys also reporting this week.
Yeah.
So we will get you a comparison of all three once Infosys also comes out. But yes, it's a results heavy week, and markets will be really dancing to the tunes of earnings only, how things really shape up. Today, however, nothing really to complain about. 25,000 has been cleared, and decisively so, because we are around that 25,100 mark. Let's see whether or not the two big numbers that are coming out post market hours will help the markets build on those gains or give up some of those gains. We'll have to discover that tomorrow morning. But for all your other news and updates, stay tuned to Money Control. Thanks a lot from both Yatin and me for tuning in. Have a great evening.